Okay, so this is part 2 on insurance for Calm. Just taking a look here, there are 2 types of life insurance, term and whole life. Now, the difference between the two is rather unique. Term life insurance is a policy where they pay premiums, and if they die, their beneficiary gets some money. But after the term ends, the policy ends. So term would be, let's say, okay, for the next 20 years, will I die? Yes or no? If I die within that 20 years, that is, I get paid. So if I die here, get paid. If I die here in the timeline, do not get paid. Okay, and that is term life insurance. Okay, whole life insurance basically says, okay, well, now for your entire life, this is what will happen. Well, if you can imagine, if I die here, get paid. If I die here, get paid. If I die at, let's say, 125, get paid. And so there are, now usually they have additional payments that are also come in, so it's not just for the life insurance policy, but they try to wrap something else in terms of investing, but usually the return is actually very low on that. It's kind of like if you go to McDonald's and you get an oil change done as well, that could be something. And now there are some other policies, and if you're looking at one of these, I would suggest that you do take a look at this. But really, a person who's 125, why is it when they die do they actually then need the money? They're really just leaving it to other people. So whole life says, hey, if you're like, so the question that becomes which one? Honestly, let's say if in my case we chose term life insurance. Now we chose term life insurance because 20 years we get paid. Well, what happens after that 20 years? Well, kids are growing. We will still have assets that we will get, and so we don't need the life insurance. Now, our life insurance policy came to approximately $80 per month. If we were to try to get the same life insurance on a whole life policy, we were looking at about $1,500 per month. So the amount of money is very, very significant, right? And so we chose term life. We don't need it past the 20 years because our kids will be growing. They're not going to need the money, and there's still a house to sell, and there'll still be other things going on, so they'll be covered. Now, in the case of my wife and I, we also got critical illness insurance, which basically means against diseases such as cancer, things that are going to be long lasting. And this usually is a tide over, because if I wind up getting a disease, there will be a time in my life where I can't work. And so this covers that basically until I die. This will be a one-time payment if I wind up getting the disease. And it's designed really to just kind of be a tide over. It is more likely that this will happen, so the payments are bigger. Our critical insurance is also about $100 a month. However, the payout is significantly less, right? Because the insurance company figures there's a more likely chance of me getting a disease than dying within the next 20 years. Now, some it says most here. Really, I should say some. Some policies include provisions such as all payments made to the policy get returned to you if they don't pay out. So if I kept putting in $100 a month and I don't get the disease at the end of the battle, I get that money back. Why would an insurance company do that? Well, first of all, they're trying to get you to buy their product. But what have they really done? You've basically given them an interest-free loan, and the insurance company keeps all the profits because they are going to be investing it, right? I'm just getting the flat amount. So 100, let's say, times 12 months, times, let's say, 20 years, because it's a 20-year policy. How much money am I getting in? Well, with those numbers, I'm going to be getting back, let's say, $24,000. Now, this was a $100,000 policy. So, if I don't get it, instead of getting 100, if I don't get the disease, instead of getting 100,000, I'm only getting 24 back, which is the amount of money I put in. But over the years, as soon as I put this $100 in, the insurance company is then investing this. And the amount they've made off of that, they may have made, let's say, another $15,000 off of the money that I put in. And the insurance company is keeping that. And they are paying out 24, and they do not need to pay out the 100. If you've got one of these type of policies, they will cost more than if you don't get your money back, but it's just taking a look at how this all works. So to wrap up, insurance, again, is simply it's basically an emergency lottery. That you do not want to win. And you want to have it will cover big expenses. Things that if the event happens, you will be covered, and you don't need to cover it with your emergency fund other than possibly the deductible. Right? So the deductible, I misspelled deductible. Anyway, that is not covered by the insurance. And that's basically how insurance works. If you got any questions, let me